The analysis for today shows that Bitcoin is currently trading in a very strong bullish structure around the $93,000 level, which represents a significant recovery from the recent dip we saw earlier this week. The market sentiment has shifted drastically towards optimism because investors are now pricing in a 94% probability of a Federal Reserve rate cut at the upcoming meeting on December 10th. This expectation of monetary easing is acting as a primary catalyst for the price action we are witnessing today, and it is causing capital to flow back into risk assets like Bitcoin and Ethereum. We can see on the technical charts that Bitcoin successfully tested the $92,000 support zone, and the aggressive buying at that level confirms that there is strong institutional demand waiting to buy the dips. The price is now challenging the resistance zone between $94,000 and $95,000, which is a critical area because a breakout above this level could trigger a massive short squeeze. Heatmap data indicates a large cluster of short liquidations sitting just above $94,000, and if these positions are forced to close, it will create a cascading effect that drives the price even higher towards the $100,000 mark. The daily candle structure looks incredibly healthy as we are seeing higher lows and higher highs, which is the textbook definition of a bullish trend, and the momentum indicators like the RSI are rising but not yet overbought, suggesting there is still plenty of room for upside movement. We must also look at the USDT analysis because the stablecoin market capitalization has hit new all-time highs, meaning there is an enormous amount of dry powder sitting on the sidelines, ready to be deployed into the market. When we analyze the USDT dominance chart, we can see it is breaking down from a key resistance level, and historically, every time USDT dominance drops, we see a corresponding rally in Bitcoin price as investors rotate out of stablecoins and into volatile crypto assets. The correlation between the increasing supply of Tether and the rising price of Bitcoin is undeniable. And the fact that the Federal Reserve is officially ending quantitative tightening adds another layer of bullish fuel to this fire. Institutional inflows into spot Bitcoinics have turned positive again after a brief period of outflows, and this renewed interest from Wall Street is providing a constant bid under the market price. The macroeconomic environment is aligning perfectly for a classic Santa rally as we approach the end of the year, because historically December is a strong month for crypto when the stock market is also performing well. We should also consider the derivatives market, where funding rates have remained relatively neutral despite the price increase, which tells us that this rally is being driven by spot buying rather than over-leveraged speculation. This is a very healthy sign because it means the market is less prone to sudden liquidation wicks, and the foundation of this upward move is much more stable than what we saw in previous months. Traders should keep a close eye on the $91,800 level as a short-term support, because if Bitcoin holds above this area, the path of least resistance remains strictly to the upside. The broader altcoin market is also waking up with Ethereum crossing the $3,200 mark, which confirms that risk appetite is returning across the entire digital asset ecosystem, and not just concentrated in Bitcoin. The geopolitical landscape is also playing a role as global uncertainty drives more investors to view Bitcoin as a hedge against traditional fiat currency debasement, and this narrative is gaining traction among corporate treasurers who are looking to diversify their balance sheets. We are also observing that long-term holders have stopped selling and have returned to accumulation mode, which significantly reduces the available supply on exchanges and creates a supply shock scenario. If the Federal Reserve confirms the rate cut next week, we could see the US dollar index weaken further, which would provide an additional tailwind for Bitcoin to smash through its all-time highs before the year ends. The volatility is expected to increase as we get closer to the daily close, so it is essential to manage risk carefully. But the overall bias remains overwhelmingly bullish as long as the macro data continues to come in softer than expected. The volume profile shows a significant value gap above the current price, meaning that once we clear the $95,000 resistance, there is very little friction to stop the price from surging directly to $98,000 or higher. This combination of technical strength and fundamental support creates a high probability setup for long positions, and we are likely seeing the beginning of the final leg up in this bull market cycle. When we dive deeper into the on-chain metrics for today, we can see a fascinating divergence between the price action and the exchange reserve data, which tells a completely different story than the standard price charts. The amount of Bitcoin held on centralized exchanges has dropped to a 5-year low, which effectively creates a massive supply shock crisis because there are simply not enough coins available for sale to meet the incoming demand. We must pay attention to the miners because the hash rate has just hit a new all-time high, demonstrating that the network security is stronger than ever and miners are holding onto their rewards rather than selling them to cover operational costs. This behavior from miners typically precedes a parabolic run because it removes a significant layer of constant selling pressure from the market and forces buyers to bid up the price to entice long-term holders to sell. Looking at the 4-hour time frame specifically, we can observe a tightening of the Bollinger Bands, which indicates that volatility has compressed significantly and a violent expansion is imminent, likely in the upward direction given the prevailing trend. The Fibonacci extension levels drawn from the previous cycle high suggest that the next major technical target sits at $102,000, and the current consolidation is merely a refueling station before we attack that psychological 6-figure barrier. We also need to analyze the USDT liquidity pools on major decentralized finance protocols because the yield for lending stablecoins has spiked dramatically, which signals that traders are borrowing USDT aggressively to leverage up their long positions on Bitcoin. This demand for leverage is healthy as long as the open interest does not get too overheated, and currently, the open interest to market cap ratio is still within a sustainable range. Another key factor is the behavior of the 50-day moving average, which has acted as a dynamic support level for the past 3 months, and as long as the price stays above this moving average, the medium-term trend remains indisputably bullish. The Fear and Greed Index is currently reading extreme greed, but unlike previous cycles, this sentiment is being driven by institutional adoption rather than retail mania, which makes the current price levels much more sustainable. We are also seeing a decoupling of Bitcoin from the Nasdaq and S&P 500 indices, which is a very bullish development because it means crypto is starting to trade on its own fundamental merits rather than just following the risk-on or risk-off flows of the traditional stock market. The weekly chart is printing a massive bullish engulfing candle, and if we can close the wick above the previous weekly high, it will validate the continuation pattern and likely draw in momentum traders who trade solely based on higher